All right, well, welcome everybody to a brand new week ahead. Now, I think the very best way that we can summarize the price action that we saw last week is with the words aggressive choppiness. You know, we closed out the week with a market that definitely feels a lot more nervous than it was just a week or just 2 weeks ago. We saw a very sharp bout of risk off sentiment hitting the markets very early on Friday. And those things that has tended to do very well so far this year took a massive beating initially, right? We had equities plummeting to the downside, those very high speculative names and assets like crypto saw big moves to the downside on Friday. Things like gold, which has done well, saw a huge capitulation as well. Now, what's interesting is that we obviously had the US government shutdown coming to an end last week, after what was it, 42 or 43 days of being in shutdown. And that was supposed to be something that could have, kept the markets happy a little bit in the short term. But we just didn't see that as being a big driver last week. We saw some initial moves in certain asset classes, but those things faded, and it seemed like risk sentiment was really just the main theme that the markets latched onto towards the end of last week. Now, in terms of the driver, the reasons for why we saw that bout of risk off, it's a little bit of a tricky one to explain, because for the most part, if you ask any type of financial media outlet, they will tell you that the main reason why the market's traded this way is because of fading expectations of a Fed cut in December. Remember, just a couple of weeks ago, just a week ago for that matter, if you take a look at Fed expectations, just a week ago, the market was pricing in a close to 70% probability of a cut for that December meeting. If you fast forward that to Friday's session, or let's go to Thursday. Thursday, that was at 50%. By the end of Friday, we were at 40%. So the markets have essentially dropped all the way from a close to 70% probability or chance of a cut all the way down to 40. Now, that has been touted as one of the biggest reasons why we saw the markets react the way it did. But I do think there's more to it than just fading cut expectations, which we'll get to in a second. Now, firstly, why have the markets dropped their expectations for rate cuts so much over a very short space of time? It's mostly because of the recent Fed speak that we've had. If you take a look at the majority of Fed members that we've heard from recently, the vast majority of them came out either very neutral versus what the market was pricing in for December, and some of them obviously coming out pretty hawkish as well. Now, there were some members, obviously the likes of Moran, they came out more dovish overall. But if you look at all of the others, the vast majority, the ones that we had, comments coming out from Hammock was pretty hawkish. If you had comments, looking at comments from Schmidt, that came out pretty hawkish as well. Now, these were known hawkish members among the FOMC. But in terms of the aggregate, you'll look here that from an aggregate point of view, there's 12 members right now out of the 19 that came out slightly more neutral in terms of their stance. And the markets have slowly started to drift back or cut back their cut expectations, because what a lot of these guys have said is that, listen, we're flying blind right now. We don't know what the data is showing us, and maybe that means we don't have to cut rates again in December. Maybe we just keep policy somewhat restrictive until we get more information and see what's going to happen to the labor market and obviously inflation as well. So that's been a key driver, definitely, for the price action that we saw. But there's two things that makes me doubt whether what we saw on Friday was really just down to fading cut expectations. The first thing is that these cut expectations didn't change suddenly on Friday. It's been drifting lower and lower and lower over the course of the last week, right? This is giving us 3 snapshots: a week ago, Thursday, and Friday. But it's been drifting lower ever since over the last 2 weeks. If that was really a primary driver, then you would have expected the markets to react to this far sooner than suddenly realizing on Friday, oh wow, we're actually down 16% from a week ago in terms of cut expectations. So that's the first thing that makes me doubt this. The second one is just looking at the price action. If you look at something like the dollar, in any environment where you have cut expectations going from 70% down to 40%, that should normally translate into strength for the currency. The dollar ended the week lower. That is not what you would expect. Similar story if you take a look at something like gold. Gold is normally a a more rate sensitive asset. And yes, we did see a big plummet going on Friday, but for the majority of last week, while rate cut expectations was falling, gold was soaring and was doing really well. So if you look at the price action in the dollar, if you look at the price action in gold, I'm just not sure whether this fading cut expectations is the only reason for why we saw the markets react that way. And I mean, the other thing, is that rate expectations for December, we know it dropped to 40% or close to 40%. But by the end of Friday, not the initial bout of weakness, but by the end of Friday, price action looked a little bit more balanced when it comes to equities. The equities is normally an environment where you would expect rate cut expectations to really drive things. And even though we saw initial downside, we basically closed flat on the session for the S&P and flat on the session for the NASDAQ as well. I mean, treasuries even saw a lot of two-way price action. Yields was initially lower, as you would expect on for something like an increase in cut expectations, but yields finished the session high with bonds lower, which is just not what you would expect when you see the markets trade that way from a pure risk sentiment point of view based on interest rate expectations. So the bottom line is, yes, I think the fading cut expectations definitely had something to do with the price action last week. But if you take a look at how the dollar traded, if you take a look at how gold traded and equities traded and treasuries traded, I think there's more going on right now. I think what explains the price action a little bit better would be a perfect combination of a few things right now. You have, yes, fading rate cut expectations, but maybe also just simple profit taking as we head towards the end of the year. You also have continued worries about the US labor market. That for me is probably, a more suitable driver for what's going on, because that would explain why you're seeing equities lower initially. That would explain why you're seeing the dollar trading heavy, but that wouldn't explain weakness in gold. It wouldn't explain upside in yield. So again, it's not just one thing, it's a combination of factors driving it. And I think that's very important. So I think, just blaming Fed speak for what happened, I think that's just taking the easy way out. I don't think that was the primary driver. We have to remember in these types of environments, trading is hard, right? Because the markets are complicated. It's more complicated than just simple narratives that we can latch onto every move that we see. We have to understand the bigger picture and how things are expected to move, and be humble enough to say that, hey, you know what? Yes, this is a possible driver for this thing, but I don't think it's just that. I think there's more to it. Even though there's not one particular thing we can pinpoint to, there's certainly more than one factor that's been driving these markets, I would say, over the course of the last 2 weeks or so. So with that said, with that backdrop, we are heading into a pretty busy week when it comes to the US calendar, or the calendar just in general. We've got the FOMC meeting minutes coming up. I'm not too excited about that, but that is something that the markets will be watching, especially after that more hawkish shift we had from the FOMC more recently. The main event, though, and the one that I reckon everybody's excited to get, is finally some US data, with US jobs numbers coming up on Thursday. This will be the September data, though, but we'll touch on that in a second. We also have some inflation data from the UK, inflation data from Canada. We also have a very important earnings print coming up with Nvidia. So there's quite a few important market movers coming up this week. Now, let's touch on the one that I think is going to be the most important, and that is the US jobs report. We've got good news and bad news when it comes to US data right now. The good news is that the US government shutdown is finally over, which means we'll start to get some US data again. The bad news is that it'll take at least a few weeks for the BLS to both collect, clean, and obviously release all of the data. What we will be getting in this week ahead is we will be getting the release of the September US NFP report, not the most recent one, the September one, which will be released on Thursday. At least that is what the BLS told us on their website. Now, the big theme for this data, I think, is a little bit less the exact number and more about just finally getting some visibility back on the radar for the Fed. Going into this, markets are already expecting a softer print because we had a lot of third-party indicators like the ISM data, the ADP data, pointing to a cooler hiring environment. Again, not the most recent data. This is the September data we are talking about, right? Now that fits, I would say, with the broader narrative from private as well as the state level data during the shutdown that we had, which already showed that there is a trend towards softer job creation. Now, when it comes to this print for the Fed, the stakes are pretty high. I mean, policy makers, we know they've been flying blind after weeks without any official data, and we had majority of FOMC members have been arguing that maybe there's no rush for them to cut in December until they see a clearer picture of the labor market. So this report will be their first proper look under the hood of the US labor market since we had the shutdown start. Now, due to the delay in the data, we also need to take the previous forecast that we had for this data with a little bit of a pinch of salt, right? These forecasts, they do not have the benefit of hindsight like we do, right? We've seen the ISMs, we've seen the ADPs, we've seen the state level and private sector data that has shown a possible, lower trend or a softer trend in job creation. We know that already. These forecasts did not know that at the time. So we need to take these things with a pinch of salt. It's likely that the whisper number or the new information adjusted forecast, if you will, for these numbers will most likely be lower than these initial forecasts that we had, right? So the whisper numbers or the market's expectations is probably no longer 50,000. It's probably closer to 30 something or thereabouts. Now, in terms of market reactions from this one, with money markets pricing in basically a 40-60 split, between a cut and a hold, it means either a very big miss or a very big beat could actually offer enough short-term volatility to look for a possible trade. However, with the markets already, expecting a more softer print, or a print that's on the soft side, it will take a much bigger miss, I think, to surprise the markets compared to a beat. So for a miss, we probably want to see a negative jobs print, something like negative 30,000, definitely more than negative 20 because the market's already leaning softer. So I reckon we would need to see something like negative 30 or negative 40 to get me really excited. And if we were to see the first negative NFP print in, since COVID times, a negative print could really accelerate some of that downside that we saw last week in the US dollar. On a negative print like that, I would not be surprised to see the markets trading back down towards these recent lows around that 98.60, maybe even lower, maybe even back down towards 98. It's possible if the data comes in really ugly with a very negative print. Also on the back of that, you would expect some recuperation in that weakness we had in gold, potentially aiming for a move back up towards that 42.40 from last week, Thursday. When it comes to equities, though, it's a little bit of a tricky one because initially equities could see a small rally on a negative print because that will increase the odds of a cut once more, right? If we get a negative number, that should see that cut probability rise to maybe up to 60-70% if it's negative, maybe even higher. And that could see some initial upside for equities. But at the same time, what does a negative NFP mean? A negative NFP print means higher unemployment, which means lower economic demand, which means higher risks for lower growth, which is not a very positive outlook for US equities or earnings in the coming quarters, right? So the worse and worse the data gets, it could actually be a negative on equities, not a positive. So I reckon the simplest way to express a very big miss or a very big beat this week in that jobs data would be to either express that via FX or express that via metals. If we were to get a surprisingly strong number, something like in the vicinity, I would reckon of, let's say 70 or 80K, a real decent number, that should be enough to see the markets, pricing in maybe closer towards a 20% chance of a cut. And despite the dollar not really rallying last week on the back of fading cut expectations, I think it'll be really tough for the markets to ignore a very strong print for the dollar, right? I reckon there could be enough momentum to push the dollar higher if it's a really strong number. And that could also be enough for gold to, revisit these recent lows around that 3,900 level. If it's a really strong number, maybe that is, the straw that breaks the camel's back type of thing when it comes to gold. So it's definitely one to watch. It's going to be the main event for the week. And I'm hoping for a very, very juicy deviation there to get the markets excited. Now, apart from that, we also have some UK CPI data coming up this week. Now, this one could be interesting, after the previous CPI that we had for September, as well as the previous Bank of England decision, and obviously after the recent, fiscal shenanigans from Rachel Reeves, the pound has been on the back foot. If you take a look at pound dollar, it's really struggled for momentum over the course of the last few weeks. Now, again, there's been a whole range of things that we just mentioned. The Bank of England, there was the previous CPI, the fiscal situation. All of those things have basically seen pound really struggle, with pound dollar, trading still around that 130-150 level, despite the weakness we saw in the dollar last week. Now, if you take a look at expectations, because of demand indicators that's been rolling over in recent months, consensus is looking for a softer print for the year-over-year numbers across the board. You can see core CPI is expected to go from 3.5 to 3.4, headline is expected to go from 3.8 to 3.6, and services expected to go from 4.7 to 4.6. So markets already expecting that lower print, and that type of outcome would just back the current market pricing. But we would need to see something, I think, a lot bigger to trigger a decent enough reaction in the short term to want to get involved. I mean, consider it this way. If you look at pound or BOE expectations, the market's already sitting on about a 75% chance of a cut for December. So if we were to see, or if we want to see that coming in with a close to 90%, we probably want to be seeing a print well below the market's minimum expectations, right? We want to see something maybe closer to 3.2% for the core, something closer to 3.3% for the headline, and for services, something closer towards 4.4. We want to see a real big miss. If we do get that, I think that is, in my opinion, the simplest way to trade the pound this week. Why? Because we've got the budget coming up next week. If we were to see a really juicy miss, there's just no more reason for the Bank of England to then stay patient, right? You're expecting tax hikes, which is going to be negative for growth and employment. You're expecting spending cuts, which is going to be negative for both as well. Now you're seeing inflation pushing lower better than or faster than expected. There's just no more reason for them to stand pat. And apart from December, the markets will most likely be able to flip those February expectations towards a cut as well if the data is negative enough. So I reckon that would be my preferred play, to look for some weakness, continued weakness in the pound if we were to get a really big miss. But what if we get a massive surprise beat? Look, a beat could be a tricky one for us to trade, because yes, an upside surprise could see some of that some of that 75% probability of a cut. It could see some of those odds being faded lower, maybe closer towards a 70 or a 65. And that could provide a bit of short-term, very short-term relief for the pound. But even if it is that type of beat, the markets will very quickly, in my opinion, remember that we have the budget coming up the week after, on the 26th of November. Right? So with that still the main focus point right now, I don't think a beat is very attractive as an opportunity. And because I'm not sure how fast the markets will want to just discount a higher inflation number in favor of just using any upside moves we see in the pound to simply just position themselves for more downside heading into the budget. Because remember, the markets have been pushing the pound lower in anticipation of this budget coming up. If you have a higher CPI number, yes, maybe we push up towards that 132.60 level. But if we get there, I wouldn't be surprised to see the markets leaning back into pound weakness as we trade, as they potentially look for weakness going into the budget from next week. So that's the way that I'll be looking at the UK CPI data. We also have Canadian CPI data. This one, I don't think we're going to get a lot of bang for our buck. Look, CPI right now, I think, is more about confirming that the Bank of Canada is done cutting rates rather than setting up another move. If you take a look at expectations, the markets are expecting the headline inflation to drift from 2.4 down to 2.1. But, and this is the most important part, the preferred measure of the banks, or the BOC's preferred measure of inflation, core inflation, that is the average of CPI median and CPI trim. That is expected to drift to 3.1 from the prior of 3.2, which is still above the bank's 1 to 3% target band, right? So what the markets are expecting here should not change anything. And again, taken at face value, if we get this type of print, that'll just reinforce the message that we had from Governor Macklem, that they think policy right now is at right about the right level. Because regardless of what they do from here, interest rates can't fix the tariff problem. That's what they basically told us last time. They told us, hey, we're not going to cut rates again. And everybody's like, oh, wow, that's a positive for the CAD. It's not a positive for the CAD. They came out dovish. They say that, hey, we are concerned about growth. We're concerned about labor. But there's nothing we can do about it right now because it's tariff related. We're basically stuck. But they don't want to be cutting rates anymore. They think that they are okay for now. So after that last cut, if you take a look at rate expectations right now, the markets are not pricing in anything across the curve for the BOC. So, I mean, whether we get a very hot print or a very soft print, I just don't see that changing anything in terms of the BOC narrative, right? The bar is very high for this week's CPI print to change the BOC narrative. So I don't think there's a lot of opportunity there. Look, to be fair, the Canadian dollar, at least if you look at something like the dollar CAD, I think there is a lot of stretch short positioning that's still sitting on the CAD right now. So if we were to get, for example, let's say on Monday when we get this data, let's say we get a really, really hot print. We might not see as much follow through in the CAD on the back of that. But if we then go into Wednesday's session and we were to get a really soft print on something like the pound data, then maybe we could look for some, pound CAD downside, assuming the Canadian data comes in a little bit hotter than expected. It's not my favorite trade for the week ahead, but it's something that we can consider as a possible trade, given the lack of other major data points we've got coming up. Now, on Friday, we also have a string of flash PMI data coming up once again. France, Germany, UK, US. As always, the best way that I'll be looking to trade that would be differential plays, meaning if the EU data comes in really bad and the UK data comes in really good, we can look to play that against each other. And opposite, if the one comes in really soft and the other one comes in really good, the Euro Sterling pair is normally an excellent pair to look at for those types of differential plays. If the if the European data is very bad and UK data very good, you look for Euro Sterling downside. Vice versa, if the European data is really good and the UK data really bad, you look for some Euro Sterling upside. Upside, I think, is a little bit more risky right now compared to downside because this pair has just been firing on all cylinders over the course of the last few months. So I would prefer Euro weakness on a bad print. At these levels, it just looks a lot more attractive to be short as opposed to long. But as a short-term scalp, that's normally a pair that's attractive to look at from a differential point of view. Now, apart from that, the other thing we've got coming up that we need to pay attention to is, of course, earnings. Now, we've got a couple of smaller names coming up, but the main focus, as always, when it comes to these things is on big tech. And there we obviously have the poster child for AI, NVIDIA, posting earnings this week. The reason why this matters for us from a index level trader point of view, like the S&P or the NASDAQ, is because of the weighting. It's got a 7% weighting in the S&P, close to 12% in the NASDAQ, 4% in the Dow. It's a monster name, right? So whatever happens to NVIDIA, it can have a ripple effect in broader equity markets, which can obviously impact overall risk sentiment, which can impact treasuries. It can impact FX. These names matter just purely because of the weighting So it's definitely something worth paying attention to. If you take a look at implied volatility for this sucker, I mean, geez, the markets are expecting a close to 7% move on the week, either up or down, right? So it's a big range. You're talking about a close to 14% variable range on the week, which is massive. Weekly implied volatility low, interestingly, comes in very close to that recent series of lows around that 177 and 180 mark, which will be key to watch to the downside on any negative earnings. And obviously to the upside, you've got the high from a couple of sessions ago coming up right on top of the 200, which is also where we have the implied volatility weekly high, which is key levels to watch for the week ahead. So with that said, again, main focus for us will be jobs data. We obviously still have a flurry of Fed speakers coming out this week again, which we will be paying attention to. The ones that we get after the jobs data will be far more important though. So Thursday and Friday's Fed speak trumps the Monday, Tuesday, Wednesday speak. It'll all be about what they say after the jobs numbers that we get on Thursday. So with that said, I hope everybody will have a fantastic week ahead. And as always, any questions, don't hesitate to let me know. All right, warm welcome everybody to a brand new week ahead. Now, I think the very best way that we can summarize the price action that we saw last week is with the words aggressive choppiness. You know, we closed out the week with a market that definitely feels a lot more nervous than it was just a week or just 2 weeks ago. We saw a very sharp bout of risk off sentiment hitting the markets very early on Friday. And those things that has tended to do very well so far this year took a massive beating initially, right? We had equities plummeting to the downside, those very high speculative names and assets like crypto saw big moves to the downside on Friday. Things like gold, which has done well, saw a huge capitulation as well. Now, what's interesting is that we obviously had the US government shutdown coming to an end last week after, what was it, 42 or 43 days of being in shutdown. And that was supposed to be something that could have, kept the markets happy a little bit in the short term. But we just didn't see that as being a big driver last week. We saw some initial moves in certain asset classes, but those things faded, and it seemed like risk sentiment was really just the main theme that the markets latched onto towards the end of last week. Now, in terms of the driver, the reasons for why we saw that bout of risk off, it's a little bit of a tricky one to explain, because for the most part, if you ask any type of financial media outlet, they will tell you that the main reason why the markets traded this way is because of fading expectations of a Fed cut in December. Remember, just a couple of weeks ago, just a week ago for that matter, if you take a look at Fed expectations, just a week ago, the market was pricing in a close to 70% probability of a cut for that December meeting. If you fast forward that to Friday's session, or let's go to Thursday. Thursday, that was at 50%. By the end of Friday, we were at 40%. So the markets have essentially dropped all the way from a close to 70% probability or chance of a cut all the way down to 40. Now, that has been touted as one of the biggest reasons why we saw the markets react the way it did. But I do think there's more to it than just fading cut expectations, which we'll get to in a second. Now, firstly, why have the markets dropped their expectations for rate cuts so much over a very short space of time? It's mostly because of the recent Fed speak that we've had. If you take a look at the majority of Fed members that we've heard from recently, the vast majority of them came out either very neutral versus what the market was pricing in for December, and some of them obviously coming out pretty hawkish as well. Now, there were some members, obviously the likes of Moran, they came out more dovish overall. But if you look at all of the others, the vast majority, the ones that we had, comments coming out from Hammock was pretty hawkish. If you had comments, looking at comments from Schmidt, that came out pretty hawkish as well. Now, these were known hawkish members among the FOMC. But in terms of the aggregate, you'll look here that from an aggregate point of view, there's 12 members right now out of the 19 that came out slightly more neutral in terms of their stance. And the markets have slowly started to drift back or cut back their cut expectations, because what a lot of these guys have said is that, listen,